All right, welcome everyone to another one of our Camaplan webinars. Today's presentation is going to be Powering Retirement Growth, Energy-Backed Diversification with Lasting Cash Flow. As always, we're going to give a couple minutes for people to continue to trickle in. So if you're already here, thanks for being here on time, first and foremost. And if you need to run to the bathroom or anything, please do so now. Probably get started around 12:02. All right, so it's been a couple minutes. Again, thank you for everyone who's here already, and we're expecting to see some more people come in, but we want to go ahead and get started. For those of you who don't know me, my name is Matt Moore. I do business development here at Camaplan, and today's presentation is going to be Powering Retirement Growth, Energy-Backed Diversification with Lasting Cash Flow. We have members representing Kingfisher Corporation and Petrovibe, and I'll let them introduce themselves in just a few minutes. Before I do that, though, I want to give a couple of housekeeping items they're due. First is our disclosure. This presentation is meant for education purposes only. The Camaplan doesn't give any investment advice. We encourage you to go seek out the correct professionals to do your own due diligence before making any investment decisions. The other housekeeping issue is going to be how you can participate in today's presentation. So I'm going to be having a lot of questions because I've already seen the slide deck, and you're going to have questions too. Our chat feature will be turned off, but the Q&A portal will be open. So please use that to ask questions throughout the presentation. We'll find time to answer them. I've been working a lot with these guys, and they're looking forward to a great dialogue with you. So please don't be shy and ask lots of questions. And finally, if you have any questions about the presentation afterward that don't get covered, or you have any questions about self-direction, working with Camaplan, please reach out to us via email or phone. So without further ado, gentlemen, I'm going to turn things over to you. I'll pull up your presentation on my screen. You should see it here. And John, I think you're up.
Thank you, Matt. Good morning, everyone. I want to start by thanking each of you for taking the time to join us today, and a special thanks to Camaplan for hosting us. My name is John Powell III, and I serve as the Senior Managing Partner for Kingfisher Corporation. We're a venture capital operating company with a deep commitment to designing and distributing high-yield, low-risk investment products that deliver above-average market exposure. Now, at Kingfisher, our focus is very simple. We build investment vehicles that perform, they protect, and they pay. And our latest offering, the Kingfisher Resources Fund, is no exception to that. It's a Reg D fund built squarely around one of the most time-tested and tax-advantaged asset classes, and that's domestic oil and natural gas. Now, the team that you'll be introduced to, we have carved out a fascinating niche within this alternative investment sector. And I've got to tell you, that even with all the uncertainty that we're all collectively experiencing worldwide, we're overwhelmingly confident in our ability to exceed expectations because natural gas and oil is where we hang our hats. Now, look, let's be honest. There's no one-size-fits-all investment. But every now and then an opportunity comes along that checks all the boxes that investors are actually looking for: growth, consistency, and tax relief. And that's what we built into Kingfisher. We call them the three Ds, and the first is diversification. Our fund provides access to a robust 50 well portfolio, which is a strategic blend of legacy production and new drills. They're engineered to smooth out volatility and maximize your return. Number two, distributions. At Kingfisher, we don't believe you should have to wait 4, 5, 6 years to see a return that you can touch and feel. Our model is designed to deliver predictable quarterly income that scales as the fund matures, and that's cash that you can count on. Lastly, deductions. This is where we hang our hats, and this is where oil and gas shines. With up to 85% of your capital deductible in year one, the tax efficiency is unlike anything that any other asset class provides. And the result is a powerful ability to reduce your federal tax obligation. So what's going to happen now? We know that there are a lot of people that don't really understand how natural gas and liquid natural gas, how they fit into the equation. Peter Snell, he's going to take it from here and just give us a backdrop of the market sector and why this conversation is relevant. Thank you very much.
Hey, thanks, John. So, hey, appreciate everybody being here. So, I'm Peter Snell. I'm a natural gas developer. We develop oil as well. That just means we pull hydrocarbons out of the ground and sell them. And so, really, for today's context, I think it's important to understand the market, things that are going on. So what's actually happening in the market that makes this a kind of investment relevant to what's going on in our worlds. And really it comes down to the massive increase in data center development, specifically for artificial intelligence. The demand for that is surging so much so that the forecasted demand over the next 5 years is the equivalent to the addition of 40 million households. So if you know anything about what's going on in America, that's like it's nearly 30, I think 35% of the total households that we have in America. It is a huge demand for energy. And some of us may or may not know how natural gas is related to that, but it's really pretty simple. Electricity is not something that just is comes out of thin air. You've got to actually use a fuel source to create power. And in order to ensure that that power is available for everything that we plug in, including all the Teslas and everything else that are supposed to save the world, you need natural gas. It's the number one fuel source by a country mile that the electric grid uses in order to create power. You use natural gas to turn the turbines. The turbines that are turning are actually creating the electricity. The electricity is put into the system across the grid, and that's how we get power. And so that makes for a great opportunity for natural gas in this future for all of us. And there are different ways to participate in how to, take advantage of that as an investor. That's one of the reasons that we're here today to cover that. And so, real important to note that when you think about natural gas relative to the demand that is in play is the infrastructure in which the electric grid is built. It's not built for nuclear, not at scale. We are excited to see in the energy space that nuclear is having a comeback. There's a lot of development around it. It is going to be a major part of the future, but it is very difficult to scale. And the grid and its ability to actually accept nuclear power as a fuel source, which works differently than natural gas as a fuel source, is a long way out. We're at least 7 to 10 years from having any real impact on grid fuel demand relative to what natural gas is going to need or how much natural gas we're going to have to call on. The reason why is because the grid infrastructure is better positioned for scale through the addition of more natural gas fuel. So this is a good thing that makes for opportunity for those that are involved on the natural gas development side. There's a lot of different ways people could invest. We obviously like this because the fuel source, it's a little bit like the gold rush of the 1800s, where most of the millionaires were made on the supply side of gold, not actually in the gold itself. And so that's kind of how you would think about natural gas in this case, where AI may be the gold in that example. So we like where the future is for that. We have commodity pricing futures that and current prices really that reflect the surging demand that's already coming. And I'll tell you, even the infrastructure that I just talked about being better suited for natural gas from a scale perspective, there's challenges around that as well. Many challenges. When you think about the electric grid in the U.S., there's really three areas. You have Texas, you have the East Coast, you have the West Coast, and those are the three primary segments of the grid. All of those segments are regularly going over their daily capacity. They're going into their overtime or their overage capacity, and even touching the top of that limitation. So I'm telling you that to give you an example of what the demand is doing to the grid infrastructure and how important it is that we move quickly in addressing that. And that takes us back to making sure that you have the right fuel source that's going to be easiest to make power generation possible, and that is natural gas. So we're bullish about it and excited about where that's taken us. And really, I just wanted to make sure you guys had some construct to that as you think about what's going on in the marketplace. And hey, do we have a future here? Does natural gas have a future? What's that look like? So I'll cut it there and turn it over to, I think, John, is Darren's next, right?
Yeah, next slide, please, for data centers. Thank you.
Okay.
Okay.
Peter,
Yeah,
do you want to take this one or do you want me to
yeah, no,
jump
I
in?
mean, I already covered this, so we could skip through the slides. Keep going. Yeah.
Keep going.
Yeah.
Yeah. There we go, Darren.
There we
Okay.
go. There's Darren.
Well, pleasure to meet everybody. My name's Darren Hall, and I am Chief of Growth and Investor Relations with Kingfisher. And it's kind of my job to look at all the projects out there. And what I wanted to do is kind of give a brief overview of what traditional projects have looked like in this industry. And typically there's two kinds. You've got a kind of product, which we call a fund, where you just get paid like a bond, like a flat rate of return. And those products can be stable, but they don't offer a pathway to build long-term wealth. And there's not new drilling involved, so you don't get the tax credits. And that doesn't fit a lot of people's profiles. Then you have the drilling side. And with the drilling side, there's a couple things. The projects are very small in scale. Typically, they're anywhere between 2 to 10 wells, and there's no banks involved. So when people raise money, all the money is coming from investor equity. So if someone's doing a 10 well project, let's say, and they take their fees right off the top, as they develop this program and they get into it, if the first 2 to 3 wells hit, a lot of times they can become financially strapped. And what we tend to find in the industry is lots of times there can be capital calls, or they can just shut the project down if the cash flow doesn't come early on in the project. Additionally to that, a lot of these projects can have peak production very fast within the first couple of years. But then after that, the revenue tends to trend down incredibly quickly. With our project, it's very unique because we have two unique sides to it. We've got a protect side where we have 400 wells that are already existing and generating revenue. But then we also have 50 new wells, which we're building, and that's the scale side of the project. So think of it pretty simply in two ways. when you invest in a project that's got a long-term scope of 10 years, you get the upside of having an existing asset, which I would say is kind of like an insurance policy for the entire project. And just the existing side, that can provide a 2x on the return. But when you develop new wells, that can take the 2x and bring it up to a 6x or 7x. John?
Next slide, please. Yeah, thank you. Perfect.
Yeah. So here we go. So with our current project with the 400 existing wells, right now we're yielding 1,100 BOE per day. So they're already creating revenue. Now, over the next 2 to 3 years, what we're doing is we're going to use AI algorithms and new technology to take that existing output and triple it. So we'll go from 1,100 to roughly 3,500 BOE per day. And then as we're doing that, at the same time, we're starting our drilling program. And the drilling program is going to be done over the course of 7 years. And we use a very, very well-known, they use it in the stocks a lot, where we do a reinvestment mechanism. So as we do the reinvestment mechanism, as we drill and we bring revenue from our wells, that money gets reinvested. And that's the trick to really scaling a project and creating very large returns.
All right, thank you so much, Darren. Next slide, please. Yeah, so Darren was able to obviously, just inform everyone about the difference between traditional versus the hybrid model. One has a decline curve that kicks in. The other is we're growing based on compounding our dollars over a period of time, which is 10 years. The good thing to know is that this fund is managed by a team of experts, subject matter experts in all of our respective fields. I've got 17 years of experience in oil and gas as an investment advisor. Been in this industry for a long time. I've been very, very successful. Our CFO is Mr. John Paul Reach, also the 8 years of experience dealing with major middle market companies, Director of Investor Relations, Ray Contractor. He shares that role with Darren Hall, who's our Chief Growth Officer. Obviously, you guys have seen the vast knowledge of Peter Snell. He runs Petrovide, which is our venture capital operating partner. And we're partnered with 2 geophysicists. Both of these guys are rock stars, in my opinion. They're responsible for trillions of cubic feet of natural gas that have been discovered, monetized, and we use them collectively to aid the company in making important decisions on the ground. Next slide, please.
And John, I wanted to stop you there for a second.
Yeah.
As I was looking through this and we were talking, I know you kind of mentioned the fact that you have 2 geophysicists is unique. My only knowledge about, energy is through watching the show Landman, so guilty as charged. But can you just sort of talk about the novelty that you were sharing with me, just so the people on the webinar kind of understand why that's a unique organizational makeup?
Yeah, and from my perspective, I've worked with a lot of operators in my time, and typically you have a very singular type of vision. There's a geologist that is responsible for making key decisions and directing the drilling process. When we partnered with Petrovide, the fact that there's 2, and they come with very different perspectives. Watching them interact, sometimes argue, in a productive way. It creates a more 3-dimensional viewpoint and gives us a healthy balance of making proper choices. And this is a big deal when it comes to finding success, avoiding dry holes, making sure that investor capital is being deployed and stewarded properly.
Thank you.
All right, next slide, please. Yes, and so like I mentioned, we've got over 100 years of combined exploration experience. Our team is fit for the job. We're modern. We're built for the robust economic conditions of today, and we're committed to doing quite well. Next slide, please. Again, I'm just going to reemphasize, the fund is focused on diversification, distributions, and deductions. I always tell investors, if you're not looking for any of those 3 in particular, this is definitely not the place for you. We brought all of those attributes together. It's what makes this very unique and special. We're going to continue to talk about the process. Next slide, please. Peter, he's going to discuss the protect asset and then discuss how that plays into our investment strategy.
Yeah, thanks, John. So, look, the whole formula for Petrovibe is very simple. So, it's to protect and scale. That delivers a multiple, and we base that formula off of our pursuit, our understanding of a standard that's higher than our own. It's one that we adopted from the parable of the talents in Matthew 25 in Scripture. So it's important to understand why. The reason for that is when Jesus is actually talking in that parable, he's actually discussing, or he's setting the stage for a multiple. He's talking about discipleship. That's the real meaning beneath it. But the principle of multiplication is a best practice on the financial side when he's talking about this. And so we've adopted that because we're stewarding other people's money. That's what happens when we bring capital in. It's obviously not ours, so we have to look at it with the highest of standards, one that we didn't even create. It's better than we could create our own. And so that principled baseline of biblical stewardship is what creates this formula top layer, which is protect and scale. That's what gives you a multiple, or a MOIC, a multiple on invested capital. And so when we look at this specifically, we've already acquired assets, including our work to acquire the TrueRock asset, which is 386 producing wells. And it's as the slide tells you, it's generating income. Why do this? Well, it's important that you have diversification in your product mix. And just like you do in a portfolio for investments, you want diversification in your product mix, in your location, and your ability to actually produce income. And you still have to obviously have that in somewhat of a central area. And that's why we focused on the Gulf Coast area, which you see here in the map. There are assets spread out across all those different counties, but we have a similar approach to working those out, and that gives us a production profile that protects equity. So you have two ways to protect equity. One is through the tax deduction. So tax deduction provides you protection of your equity. Why? Because it creates tax savings. Now, if you get a deduction of, say, up to 100%, but let's just say 71 is our target, because that is our target for the first year, this being 2025, excuse me. So 2025 target of that's going to deliver, in everybody's scenario is different, so keep that in mind, but that's going to deliver somewhere around 30 to 50% of the deduction value and actual tax savings. So that reduces your risk as part of the protection. The second piece is actually having a tangible asset class that supports the equity that you have in the deal. And so why does that matter? Well, it's already producing income. These are already proven. So our ability to actually optimize them, when I say optimize, I mean go in and fix pipes and compressors and things like that. We apply capital to increase production over time, so that we can not only take the income that we're earning, but actually increase that. That creates protection for what's left in your equity. So let's say you had a $100,000 investment. If you have approximately $30,000 in tax savings from the deduction, and you have 70,000 left that you need to protect, you're able to do that through the backing of an equity, the backing of a tangible asset such as this. So that's how you essentially protect. That's the protect side of the formula. Now, when we say protection, that's not a guarantee. I want to make that clear. It doesn't mean that there isn't risk in the operations of that, but this gives us a way to mitigate that risk in multiple ways. We have a sheet of we have more than 36 tactical applications of risk mitigation built into the project itself. So that's the protect side. We're going to talk about the scale side next.
Before we jump into that, is there anything unique about, this part of the state, and why you're producing here as opposed to any other oil producing or natural gas producing parts of Texas? Why did you
Yeah,
choose this area, I guess, is the simple way to put the question.
yeah, it's so this is the area we've strategically decided to work as an organization for multiple reasons. One is it's the Gulf Coast, so the largest refinery system is in place in the Houston area. The pipelines are mature, so we like that because that provides us easier, lower cost access. That means better profitability. Another reason that we chose this area is there's a great deal of missed opportunities. So most of the big companies have left the area, but that doesn't mean there's not a lot of opportunity on the in between. So mostly this area, these counties are covered by small operators, and small operators don't have large operator strategies like we do, which is really built on growth through reinvestment of gross profits. And so that creates a void and an opportunity for us, and then folks that want to come along with us in the process, like John and his group. So those are multiple reasons why it's unique. Lots of good reasons. The last thing I would say is the product mix. So you're always in this area, you're always getting a mix of oil, natural gas, which is dry, and then natural gas liquids. That's your wet gases. Anything that ends with an ane, propane, butane, methane, those kinds of things. So we like it because the product mix is diversified, just like we talked about earlier in your portfolio. You want diversification as part of your strategy, right? Well, we like that in product mix as well. The reason why is because even though oil and natural gas prices are tethered, they are connected. That tethering is getting looser over time, especially as we see demand shift. So we like the diversification in the product mix within these formations that are in the Gulf Coast basin because it gives us risk mitigation and gives us more profit opportunity than we would have if we were competing with the big companies out in the Permian or in East Texas. Good question.
Awesome. Thank you.
Now, can you go ahead and move on to the scale side so everyone can understand the Wilcox Formation? And Peter, speak to that, the Wilcox Formation, how just unique that this particular area is, the amount of barrels per day equivalent that it's been responsible for producing over the last couple decades. I mean, it's actually incredible.
Yeah, I don't even know the answer to that question, but I can tell you that this is it's interestingly a very proven area. Excuse me, found
Formation.
formation, but as you think about, we just talked about protect, right? And we have a lot in this formation, but before we get into the depths of formations, I want to just give you the idea around scale, because scale is important. This is something we're doing along parallel. So obviously we have acquired and are acquiring these producing assets. We're going to optimize them to improve production, but we need to drill wells along the way. Darren sort of set the stage for that. As we dig into that, where are we focused on the drilling specifically? Well, you need to have an area that you know well, that has a lot of data available. We're not interested in wildcatting. Exploration is a broad word, right? So anytime you're drilling, you're exploring. But there are different levels to exploration. The reason that we like the Wilcox, I just talked about some of that, which is the product diversification. You see it right here in this graph. Okay, this pie chart shows you that in general, the Wilcox Formation provides you that product diversification that you like. The other part that is real important is do you have the data to understand where to go? So we saw those pictures of those gray hairs. Like, we all got gray hair. I mean, I'm in my 50s. Blaine, my president COO, he's in his 50s. We've been in business a long time. in the industry, specifically the gray hairs you saw with our geologists. Those guys, this is their backyard. They've been working this area and specifically this formation for literally decades. And I want to point out the importance of all of that. That's all good, but you need to be able to match up, not just experience. I can tell you 100 years. 100 years doesn't mean anything if I suck at it. Okay. If we're not good at it, it doesn't matter. What matters is, do I have an expertise that's developed out of that experience? And that's why this team is so intriguing, at least to me, and why I assembled it, because we have a really good complement together as a group, but also we have this expertise specifically in this area, in this, not just in this basin, but also in this formation. On top of that, now you layer in the data portion, and that's really important. So we talk about, and you see it here in the middle there, it says proven success, 3D seismic and decades of results. True, I talked about the results, but 3D seismic is really important from a tool perspective. We essentially think of radar under the ground. If you look at a radar when a storm's coming in, we have views like that where we can see where the hydrocarbons are. Now, it's not a perfect technology in science. There is risk and challenges to that, but it is a huge advantage that we've had over the last 30 years. It's gotten much better. And now we've layered in artificial intelligence. Those guys, those gray hairs you saw there, both in their 70s, they use AI every day on this project. And they're using it because it creates an efficiency and effectiveness in our ability to actually interpret what we learn from the 3D and the 2D and all the other topographical type maps that we have and everything that goes into the data underneath it. Because there's a whole bunch of information from existing wells as well, not just the pictures of what we see above ground. So putting all that together, having the right expertise and the right tools to be able to understand where to go drill and why we need to go drill there is paramount. And so that's what's exciting about the Wilcox formation. That's what's exciting about this team that's doing it. And John mentioned this, but I'm gonna put a little bit of a bow on it. He said he was talking about trillions of cubic feet of gas. That doesn't really mean anything to anybody, including me. What does that mean? Well, the two of them have in their career discovered nearly 5 trillion cubic feet of natural gas. That is enough natural gas to power the grid that runs the city of Houston for 2 decades.
Ooh.
That's a lot. And that's 2 guys. So anyway, it takes a village to do this, but we've got the right villagers, and I'm pretty excited about the scale side. We have a really good path forward with that.
Thank you, Peter.
That's it. I think. Do we have any more questions? Matt had one, but anybody else on there?
No questions yet, but yeah, just a reminder that if you're watching this in the audience, you can use that chat function to ask questions. And again, hopefully I set the bar really, really low with my landman comment, so don't be afraid to ask some questions.
Let's go ahead and talk about the capital stack and compounding in action.
Sure. Sure. Peter, thanks, man. That was fantastic. Yeah, so, for a lot of people who've done accredited investing before, especially in real estate, they might know what a capital stack is. But to just give you a brief overview, a capital stack basically shows you where the funds come into a project and how they're used. So in our capital stack, you can see at the very top that there's 5.6 million in partner equity. So that's the money that all the folks like us are investing. I'm also an accredited investor myself. I've done a lot of different projects, and this was the first one I invested in because I really liked it. And then subsequently, funny enough, later after that, then I joined the company because I really liked what they were doing. But our project's a little unique because our capital stack has a couple very interesting things. And we talked about it earlier. So we have 5.6 million in partner equity from investors. But then what's interesting about our project is we have a $4.5 million credit facility. And people might ask, okay, well, what does that mean? Well, basically what it means is that a bank is also supporting our project. And when you have a bank involved, it adds significant layers of oversight because, as you know, as most folks know these days, banks are not the easiest to borrow money from in the current environment. However, since we have real assets in our project, we also have the support of a bank. And what the bank does is that it takes the pressure off the partnership equity. So when we talked earlier about how a lot of these smaller scale projects will come back for capital calls, or if they run short on cash, sometimes the projects, unfortunately, they might have issues early on, or they might have to close early, right? Well, we don't have that problem because of the credit facility. And we've got another $12 million that we talked about earlier that we're reinvesting into the project. So basically, the 12 million, as we get more and more proceeds from the drilling program, basically that creates our own mini bank that we can use. And we reinvest that money from our own built-in bank, which adds more power to the project. And that's how we get to a total of 22 million, but only 5.6 million of that is partner equity. So what I like about this structure is that basically only 1/4 of the entire cost of the project is coming from investors. And in my experience, and all the other projects I've been involved in, whether it be real estate, whether it be storage facilities, apartment buildings, the capital stack is always very different. This number of 5.6 million, it can be anywhere from 30% to sometimes over 50%. And then another oil and gas projects, it can be 100%. So a lot of the, I would call the risk or the concern gets alleviated by this structure because we're only 25% of the total project cost.
And with, so as I'm understanding it, what makes this project unique is the reinvestment of the profits to increase the production of the increased production. And you have that here. Explain a little bit about like what gets distributed to investors kind of year over year versus what's reinvested, and what kind of, in a basic way, what that percentage looks like.
Yeah, absolutely. And so basically the way it works is as we get further and further into the program, we have a distribution table, and when it starts, we have the existing production already, which means we're going to get quick distributions in 2026, so relatively soon. And as we optimize the existing 400 wells that we have in our program, that's going to build the distribution. But then as the new drilling program comes online, it's going to start stacking up well after well after well. And when you see our distribution table, you're going to see it's going to rise very quickly. So it's kind of like adding more apartments to an existing building. As you build more and more apartments and add them on and you get more and more rents, that money keeps coming in. But instead of just collecting money, we're also doing a reinvest. So you're also compounding that money to build it up even quicker.
Got it.
So, and that's how we set it up for a good long-term investment, where over that 10 years, it keeps increasing, 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 because we're stacking up more and more and more wells that produce more and more oil and gas.
Yeah, let me weigh in on that, Matt. So and I appreciate that, Darren. It's a good setup. The specific amount, you've got two parts, right? You have protect and scale. So the legacy wells, the protect side is going to throw off cash flow that we're going to be able to use to start the distributions as we develop out the drilling program. The drilling program, nearly 100% of the drilling program will actually be reinvested early. That's going to scale back roughly between a third and 40% each year until you get to, excuse me, I think that's each 2 years, because it's a 7-year drawdown. So you reinvest cash flows or gross profits over a 7-year period of time. And at the end of the 7 year, that's over, and now you're just in cash flow. This is critical because you can think of it like two upside down. Like you got a flag on the top and you got a flag on the bottom. You see distributions climb. That does not happen in oil and gas deals. Obviously, we have a natural gas function and focus, and we like the potential lift we're going to get in commodity prices long term. But we're not relying on that. What we're doing is we're building a stack of production, because here's what's important. The reason you have to reinvest at a philosophical level: Amazon, Meta, Uber, all of those companies, ExxonMobil, BP, Shell, EOG is another large oil and gas operator. All these companies reinvest so they can grow. They're not always distributing profits. You have to create growth. Why is that so important or unique in this space, and why don't you see it? You don't see it in any other accredited investor, small independent deals. You don't see reinvestment. The reason why is because it takes long-term thinking. You have to be willing to agree in the beginning to what we call strategic compounding. Because you agree to that strategic compounding, that's why you're able to participate in what we see as a compounding growth in your distributions. Every other oil and gas deal that you're going to look at, you're going to get sold a peak number. This is the monthly we think we're going to achieve. And the small print down on the bottom, it'll say this is a max number or a peak number. But what happens is you have the bell curve. It goes up quickly. The first day is the best day, and then every day after that, you're that much closer to the decline. And that's the difference in oil and gas compared to real estate that you have to fight. And it is absolutely critical to reinvest. And that just isn't out there unless you're in a public company. And public companies don't make accredited investor opportunities. Okay. You can buy stocks, you can participate publicly, but you're not going to get this kind of opportunity for upside. The challenge is you see so much selling towards, hey, we're going to get you a tax deduction, we're going to get your great monthly income. That is bad strategy. I don't care what anybody says. You have to understand that the business of sticking a well in the ground and extracting hydrocarbons, that is its best day, is the day you put it in and you start extracting it. You have a depleting resource. How are you going to combat that? You have to build basically beyond equity. And that's one of the key things. If I want everybody to hear one thing, is you have to drill beyond your equity. You have to drill with debt strategically, not as a, oops, we messed up and got a drill bit stuck and we need $1 million to get it out. I need a credit line. I'm saying built into your model, you have strategic debt, which you see here in the credit facility. And secondly, you use both of those, your equity and your debt, to create reinvested gross profits, because that's free flowing cash flow. I don't have to pay gross profits a return, but I do have to pay equity. But if I'm using gross profits to drill new production, that's where you break free. That's where you create the compounding. And that is so critical in what we're trying to accomplish here. That is really, truly unique about the Petrovive model, and why, again, compounding economics is absolutely paramount. It's not Pete Snell's rule. It's actually not unique. Big companies became big because they were disciplined in the beginning. They were disciplined in their strategy, and they made it paramount. They made it non-negotiable. And that's what we're doing here. And that's where you're going to win. You're going to win as you go along the journey.
Thank you very much. I feel like there should be an American flag waving behind you, Peter, when you're going, at least. But no, in all seriousness, I appreciate all that perspective. Shall I scroll down, guys?
No, go ahead and yes, you can. I want to take an opportunity to actually introduce one of my favorite legal professionals, who just happens to be Kingfisher's attorney. He represents us. He built this model. I'm going to give him a chance to introduce himself, talk a little bit about his background, and then he'll give an overview of what are called intangible drilling costs, which is one of the most unique features that this asset class provides. It's incredible. Attorney Legrand, you want to go ahead and take the floor?
Absolutely. I appreciate the introduction, John. My name's David Legrand. I've been a practicing attorney since 1979. I began my career with the Ohio Division of Securities as an enforcement attorney and became counsel to the commissioner. But during that time, I got involved for the first time with oil and gas. Believe it or not, in the 1970s and early 80s, Ohio had a $1 billion a year oil and gas business. in the mostly in the southern part of the state towards the Appalachian foothills. And I was involved in multiple investigations of oil and gas promoters, and didn't put anybody in jail, but we did find issues with people engaged in improper activities, and the government took appropriate corrective action. But following my tenure with the Ohio Division, I represented several oil and gas promoters in Ohio. This was all pre-fracking, so production in Ohio was mostly what are called stripper wells, relatively shallow and low volumes of production, but with low cost. So, you know, a typical well would make 3 to 5 barrels a week. And, but you could have many, many wells in Southern Ohio. Today, of course, that picture is entirely different. Kentucky, West Virginia, Ohio, that whole Appalachian area has extensive fracking, and production has correspondingly dramatically increased. And as a result of all those activities, I got involved much more in tax in order to evaluate projects and activities, both for the government and in private practice. I had to develop a greater understanding of the tax elements involved in various deals, both real estate and oil and gas. So that leads us to intangible drilling costs. And in general, intangible drilling costs represent all the expense involved in prepping a well for production. It does not include equipment. That's why the phrase is intangible. But a lot of the improvements actually have a tangible quality, such as, you know, excavating for walls in case of a leak to contain oil within a certain area around the wellhead, the surveying, the site work, bulldozing. There's typically 60 to 80%, and many tend towards the 80%. But 60 to 80% of the upfront costs of producing oil or natural gas are subject to the intangible drilling credit. And basically, that IDC is deductible in the year in which it's incurred in full. And that's unusual because most depreciation ranges from 5 years on to, in commercial real estate, as much as 31 years. So it's a huge benefit to investors that they are able to utilize in the year in which these costs are incurred, a 100% utilization of those credits against their ordinary income from other sources. And again, this is very different from real estate. We're not subject to the passive activity loss, the PAL rules. So oil and gas offers a truly unique investment opportunity from a tax perspective. And, you know, for many investors, offsetting current taxes can have an immediate impact at a, you know, 35 to 38% maximum tax bracket. Obviously, $100 pays you back up to $38 immediately. And that's an unbelievable return on investment to get 38% of your investment back the moment you've invested, so to speak. It has such a unique characteristic. So this drilling program has, of course, a heavy intangible cost component, as all drilling programs do. So the investors have the opportunity to get some pretty exciting offsets for their ordinary income, and then enjoy the added economic benefits as described, you know, by John and Darren, and it's a truly exciting program. John, take it away.
Next slide, please. Yes, thank you. And so obviously Attorney LeGrand, what he described, just gives you a visual example of that. He's already kind of talked about the situation, but bottom line, the cash flow impact of these IDCs is unprecedented. And it's a hallmark of the Kingfisher program, and we're excited to be able to offer that. Next, we're going to transition into the comparison for IRAs. So at the end of the day, there's basically, within this format, there's three ways to get involved with this. If you have an IRA, you have a traditional IRA or Roth, or you can invest outside your IRA, which is cash. This is just an example illustrating our 6.5 time return. That's our target. If you had $100,000 invested in our fund, it shows you from the traditional IRA side kind of what your tax liability would be. With a Roth IRA, obviously there's zero based on how the Roth is designed. And outside the IRA, you're looking at about a $120,000 ordinary income taxation. But the IDCs that we discussed, they're going to obviously offset a big portion of that amount. Matt, I wanted you to also, as the expert here at Chemical Inn, anyone who gets involved with us who doesn't already have an IRA, they're going to wind up dealing with the onboarding process. Can you just speak briefly to for those who don't have IRAs? I know many in the crowd do. Some of the unique features of tax deferral and why the Roth is just such an incredible instrument to utilize if you're using after-tax dollars.
Yeah, I'm going to run through this fast because we're getting short on time. But basically, at Camoplan, we like to use the analogy of taxing the seed versus taxing the harvest. So your traditional IRA is going to be tax deferred. We look at that as taxing the harvest versus the Roth IRA is taxing the seed. So your dollars are taxed going into the Roth IRA, but then all of that return is going to come to you. Obviously, with the traditional, those are tax deferred dollars, but when you do take a distribution, that's going to be taxed. Now, in terms of the process to get started with us, it's pretty straightforward. It usually starts with a phone. And we understand where your money is going to be coming from and what kind of account you're going to be opening with us. Is it going to be a tax deferred account like a traditional IRA, or is it going to be a tax-free like a Roth? And if you're planning on making a conversion from going from tax deferred to a like a Roth IRA, then we can discuss how that process would go with you. To that point about doing the conversion, that would be an example of where a depreciation benefit like this investment has could be used toward that. But I'll be the first person to say, along with my colleagues at Camoplan, that is a CPA conversation for you to have, but just want to kind of put a little bit of context there. So once we figure out, what account you're going to be opening, we walk you through the rollover or transfer process, and that usually takes about 2 weeks. And usually once the money funds your account, we can turn that investment around and get it deployed within 48 business hours. So always happy to have a follow-up conversation with anyone about that.
Thank you so much. What we'll do, we'll go ahead and skip the next slide and then move directly to the table. Hey, Darren, you want to go ahead and take a swing at this here? Really respectful of the time and over.
Absolutely. I'll make it quick, guys. So to kind of what we talked about earlier, as we develop our program and we stack up more wells and production increases, you'll see that the first year and the first 2 years, to Peter's point, we're kind of using the existing production, but the distributions rise very quickly in the program. By year 3, after the drilling program is very well established as far as the new drilling goes, we're already a very high return. And then as you can see, it keeps ramping up over these first 7 years. And this is the time that we're reinvesting the money that we're drilling. So to Peter's point earlier, the important thing about a project like this is that you have to have a reinvestment mechanism to scale it. By the time we get to year 7 and we stop doing that reinvestment, all that reinvestment money then drops into distributions for the remainder of the project, which means we have no more costs associated with the reinvestment side. So then you can see by year 8, distributions rise significantly there. And during this time, we're already seeing a very good increase, but year 8 is really a key year. That's when it really jumps. And then from year 8, it just continues. And all we're paying at that point is low operation cost, because unlike traditional oil wells, in a gas well scenario, there's much less moving parts involved. So that cost stays down. And then, as you can see, that's what leads to our large multiple over the span of the 10 years.
Yep, thank you very much for that. We'll move on to the next slide. Yeah, and this just really sums things up. Why Kingfisher is a smarter income strategy. Obviously, security first, growing income, outstanding tax efficiency, and we're tied into the growing demand of LNG and natural gas in particular. Next slide, please.
We did have a question that came in, so I want to answer it.
Yes.
And excuse me. The question is, will this kind of investment trigger UBTI for the IRAs? And what is the financial impact? Will you need to pay extra fees or taxes? So I can answer this from my perspective, and John, by all means, you're welcome to jump in too. So from what I see on this, yes, this looks like it would trigger UBTI because of that it's a business that's creating profits. And that UBTI, that tax would need to be paid from your IRA. So as an aside, our kind of perspective from at Camaplan, and this is not, again, no endorsement, just being neutral, but we know that UBTI can always be kind of a scary topic for investors. We look at UBTI as being potentially a good thing or a positive thing, because it is the IRS allowing you to invest in a larger scope of investments and not limiting you. So I say all this to encourage you to do your own due diligence, have a conversation with John about and understand the investment more, and obviously include your CPA, and we can be a part of that conversation too. But the short answer is, from my perspective and from what I've discussed with Camaplan, it looks like it would trigger UBTI, but always happy to dig into it with you more. Anything you want to add, John?
Yeah, sure. And I know we talked about this recently, and also our legal counsel, LeGrand, he and I have gone back and forth about this topic. And, it is a good problem to have, UBTI, at the end of the day. If you have a Roth IRA, let's say you made an investment and that gets to grow tax-free at this type of multiple, paying a small amount of taxes within the IRA under those UBTI conditions is not terrible. There are some nuances that we have to look at. When I spoke to LeGrand about this recently, he is basically of the term that it will not trigger that element. I'll let him speak to that, but we will. That's something that we can drill down on.
Yeah, absolutely. Definitely a conversation to have with these guys. By no means do we want to. Camaplan is not the final answer, but we will provide as much information in that conversation as possible. Another question was the chart based on current energy prices or projected? This chart here.
It's actually based on projected. The reality is the numbers that we ran are extremely conservative. Okay, so it's the numbers, nothing was ran at current prices. They were actually below current prices.
Yeah, I can also add to that. So what's interesting is, if we look at the trajectory of the pricing right now, oil has been very flat, and it's projected to be flat around $60 for the next 10 years. So this chart is based on what we call strip pricing. And we have to use basically a very low number that the banks create. It's a wholesale number. They call it strip pricing. And in this scenario, it's $60 per barrel oil and $3 per unit natural gas. So what's interesting is we're already seeing the demand for natural gas climb due to data centers, e-commerce warehouses, residential, those kinds of things. I think Goldman Sachs predicted natural gas is going to go from 3 to 450, and it's going to stay there pretty consistently for a good timeline. So to give you an example, when the prices of natural gas go from $3 to even 450, this whole chart directly increases based on that ratio. So as prices go up, we can't factor that into this 10-year projection. We have to use a flat rate price. But we know demand's going up for gas, right? Because of the incoming AI boom. So all these numbers are based on that $3, 450, $6 is very realistic if you look at the historic pricing. And that's why we're excited at this project, because we factored a very low threshold into this return. And me personally, as an investor, I like that fact, because if we're doing a realistic scenario with our project, and I feel this is extremely realistic, it's not factoring in any upside at all for the natural resources that are going to appreciate in value.
Yeah, thank you, Darren. In a nutshell, what he's saying is that we can actually outperform these numbers based on the data. It's very realistic. Next slide, please.
Sure. And then we had one more question from that same person. It might be a good way to wrap up. And that question was, what is the minimum investment?
Well, that leads directly into this slide. So obviously our company has 5,600 shares for sale currently. The next fund will be another block available, but each share is $1,000. Minimum 25 shares. We have A and B class. What's good about that? The A series shares, you get your principal back within a year. Okay, so those are the most coveted available. There's 600 of those. There's already demand for those shares. They have a priority accelerated distribution. But yeah, we're available for conversations. As a matter of fact, what I was going to ask you, Matt, is if you could send out, you have a link. I don't know if you can distribute this to the group. Check your email to Calendarly link, and that we want to make sure that that's available so individuals can have conversations with us, get on our schedule, and we'll be more than happy to entertain participation conversations, answer questions. Darren and I will be here to speak with those that want to take the next step for participation.
Awesome. I'm
Yeah, John,
literally
and just to add to that, John, like this is a really good overview of our project. But what our goal is that we want to talk to every investor individually and have a really good conversation with you guys and help you come up with a custom plan for you. This may be your first time in this space, but then that's okay. We all had to do something like this for the first time. And the trick is we will help you figure out what the right investment amount is based on what your goals are for growth. Or maybe you've got different goals because of the tax issues, right? That come along with what you have to pay every year. But what we'll do is we'll factor all this in and we'll take a look at your goals, and John and I will help you create a custom solution for you in this program that fits your needs.
Yes, thank you, Darren. Well, once again, Matt, we appreciate Camaplan hosting this event. And we thank the panel and each and every one of you that participated with us, and we're looking forward to speaking to you soon. And then Matt, you'll make sure that link is available for those who'd like to get on our schedule.
Yeah, absolutely. I'm just kind of racing through to find it right now. Bear with me, everyone. I just got it. Great. So I'm going to put it in the chat right at this moment. So I just added it to the chat. If you would like to reach out to John and start the conversation with him and Darren, by all means, please use that. Right. We're at 1:03, so let's go ahead and wrap it up. Thanks a lot, all of you, for joining us today. Peter, John, David, and Darren. And of course, all of you who attended, thank you very much for being here. Really, really appreciate your time. If you have any questions for these gentlemen and you don't want to go through Calendly for some reason, you're always welcome to email Camaplan. We'll pass those along to them, of course. Otherwise, we'll see you on the next one next Thursday, and have a great day. Thank you very much.
Thank you.